All right. Hello and welcome live from our studio. I'm David Kinder, registered financial consultant, charter life underwriter. I'm joined with my co-hosts, Mike Moffat and Kurt Gibbs. How are you guys doing this morning?
Doing
Good,
well.
man. How about you?
I'm doing all right. We're going to have some fun with this one. We're going to talk about the 15-year mortgage. And we laugh because we have a certain understanding of finance and economics and things like that. At the same time, I also have to recognize that home ownership has a lot of emotional connotations, a lot of emotional feelings that come along with it. But today, we just really want to talk about the economic, the financial, and perhaps even business side of home ownership, how we own our homes, and things like that. And we're gonna have fun things to talk about. And I swear, I don't go looking for these things. But dang it, TikTok, it keeps showing this stuff up. And once I got it, I'm like, that's it. I got to download it. We got to talk about it. So here is the infamous guy who thinks he knows a bunch of stuff, and we're going to talk about it. Here's Dave Ramsey talking about a 15-year mortgage here.
Most you should borrow. And it's the only thing I don't yell at you for borrowing, but I would prefer you didn't borrow or that you borrow less, and get it paid off as soon as possible. But the most you should borrow is a home on a 15-year fixed rate where the payment is no more than a fourth of your take-home pay.
I don't know what world he's living in.
Well,
If your
on the
take
surface,
home pay, yeah,
on the surface, it seems like reasonable advice, right? I mean, why would you
yeah,
be opposed to
exactly. I call it silo thinking because they're only looking at this transaction, not looking at much of anything else beyond that. And if you are a married couple and together your dual income is $100,000 a year gross, and he's talking about 25% of your gross income allocated towards payments. That's $25,000 a year. I didn't do the math on that. I'm doing this from. I
just call
should
it
have
two?
done the math.
Just call it $2,000 a month.
$2,000 a month. What kind of house can you buy? Can you buy for $2,000 a month? And do you really want to live in that neighborhood? I'm not sure I want to be in that neighborhood, unless. And
Well,
we'll talk about this later. Unless you have enough money to put down on the home.
and
But
especially when the median house price in the United States is over $400,000 now.
yeah, and why can't I find a calculator when I'm looking for it? That is, no, there it is. Okay, so if we're looking at $2,000 a month, we times it by 12 for the 24,000 a year. Let's times that by 30 years worth of payments. That's a $720,000 gross thing. You got to discount it for interest. Let's say you could get a $500,000 home, maybe. Now in California, you don't want to buy that house. Now in other parts of the country, it might work out just fine.
Mm-hmm.
But I'm like, really, can we really do that? So I don't know, and that could be an older clip. I'll give a little bit of credit. I don't know when he said that. He looks a little bit younger there, so maybe it was 5 or 10 years ago. Who knows? He's a 15-year mortgage. Get that thing paid off ASAP. What do you guys think about that?
Well, I think we're going to put some math to that numbers here in a little bit. But as the title of the video says, when you really look at it, the math just ain't mathin'.
Yeah, I mean, it's just like what you said. To start off, it's about perception with a lot of this, and it's also about the comment, what it really is on the surface. I mean, where you live and demographics have a lot to do with what kind of home someone's going to get in, and it may have something to do with whether they choose a 15 or a 30 as well. I mean, there's some variables there that are pros and cons to both, but I think we'll find out what the truth is, I guess you would say, as time goes on here in the cast.
Yeah, well, we've got an agenda here to share, and I mean the bullet points to share, not necessarily saying you got to listen to us and be brainwashed by us or not. But let's look at this as pragmatically as possible. And let's start with the worst case scenario. And the worst case scenario is somehow something happens to one's income and they can't keep making the payments. And what happens? And I've actually got a video on someone's story on that. I'll share that in a minute. And it's about a 5-minute video, but it's worth going through. the main thing about a 15-year versus a 30-year, yes, the interest rate is lower, but why is that? And the reason is because the bank gets their money faster. It's an accelerated payment. So they give you a little bit of a discount to say, hey, pick this one, you'll pay a little bit less interest because we get more of our money back. And they do it faster. The only problem is that, of course, because it's accelerated, you're obligated by about 40% more each and every month to that payment. So if something happens, it's not like you can just go straight to the home equity to get it unless you've prepared in advance. So I want to share. This is maybe it was like 12 years ago. Oh,
right,
go ahead,
exactly. So, yeah, no, if something does happen and you aren't able to make the payment and you do need to, get money out of the house, that's not going to necessarily be possible, because if you don't have a full-time job and you don't have a source of income and you don't have any other assets, you're kind of screwed.
Unfortunately, yeah. So this is a gentleman. He's known by Professor Rodney Balance, and he had at the time was running an insurance agent mentoring study group, and he's doing a small class here, and he's talking about one of his students who was able to take care of things, but then one of his friends that wasn't. So I want to share what the consequences are of following the 15-year mortgage advice and what could possibly happen. So let me share this.
Last year, we did a live event in South Carolina where one of my advisors, who's part of my network, worked with a family who had the man had lost his job, and basically just revamped their financial situation. He helped them realize idle assets, maybe where they were paying too much in one area, and just redirecting a lot of things to ease their financial burden. The gentleman who had lost his job that my guy was working with had a friend who had also lost his job. His name was Roy. Roy heard all these great things about what was going on and how they were able to transform their finances and everything. And Roy got message back to me. He said, please, Mr. Balance, tell everybody you meet about what's going on here. You see, Roy had gotten himself a 15-year mortgage. He had listened to these entertainers on the radio. He paid extra to that 15-year mortgage. He sent extra to the mortgage company to pay down his note even faster. He sent extra to his credit card bills. He had 4 months worth of family expenses in a savings account, and he overfunded his 401k at work. In other words, he put way more in than what the employer was paying. Now, what happened was Roy lost his job the same time this other guy did. But Roy had a 15-year mortgage. Now, one thing that is true on a 15-year mortgage is the monthly obligation to the bank is always about 40% more than it is with a 30-year mortgage. So now Roy's obligated to the bank for 40% more than he needs to be every month. The first thing he does is stop sending extra to the bank, which was a good thing. And he stopped sending extra to the credit card companies and all these folks. And he tapped into his 4 months worth of emergency fund. Roy sent message back to me to let me know that 4 months worth of an emergency fund really is equal to 2 when you don't have any money coming in. When you really think about it, when you think about, you set aside 4 months worth of what you think your family's expenses are, you can really count on that lasting about 2 months in real life. He said because they went through that like water. Then they turned to his 401k and started drawing money out of his 401k. Now naturally, he's hit with taxes and expenses because he had to ask permission to get to it and a penalty to access it. Now, what he did then was went to the bank. You see, Roy only owed $50,000 on his house. The house was valued at $185,000. $185,000. Now, what is the one thing that you have to have in order to borrow money from the bank?
Credit. Job.
A job. So he had what, $135,000 in equity in his house. He couldn't get to it because he doesn't have a job. Who owns that equity? The bank. So is the bank going to give you access to their money without assurance of you paying it back? No. That's one thing people lose sight of when you're dealing with mortgages and equity is it's not really yours. It's theirs. You've given up control over and access to your money in a promise of paying your mortgage off faster. Now, Roy lost his home. They foreclosed on his home, only owing $50,000 on it, and they sold it at auction for $125,000. Who do you think pocketed that $75,000 profit? The bank. Because the bank in foreclosure owns that property. So the person who bought the house, maybe even one of my clients who I've recommended buy foreclosed properties, got a $185,000 property for $125,000. They made out great. The bank sold a property for $125,000. The only obligation on it was $50,000. So they made $75,000 profit. They made out great. Roy now rents a home for about the same amount per month that he would have been paying if he'd have had a 30-year fixed mortgage. All of this could have been avoided had he gotten a 30-year fixed mortgage to begin with and redirected the money, the difference every month, towards something that was earning interest for him that he had control over and access to. Make sense?
Such a terrible tale. Oh, let me unmute you guys. I heard some background stuff, so I muted you. But such a terrible tale of stuff that when things can go wrong, the domino effects of everything, and then bringing it all back to say it all could have been avoided if you just did it this way from the beginning.
Well, David, I think there's a lot of things you can really take from that clip there. That's other than a 15 and a 30-year mortgage, is the fact that understanding really how the wealth works with any financial product you're in can have catastrophic circumstances to it. A qualified plan was brought up in the clip. The 401k. How it handcuffs you in so many ways until certain ages, and the access of cash when you need it, in something that you can't get your hands on in an emergency is can create bankruptcy. I mean, really, it's never ending what can possibly happen when you don't understand how money really works, how the wealth of our country and how things are determined without the understanding that you need can just be catastrophic.
Well, the math tends to work as long as we're always working and earning very, very well. That's the way that kind of this silo thinking is. As long as everything works out fine, it works out fine. Problem is, not everything always works out fine, and that's the problem.
Well, it's like they, it's the myth. You could probably take a poll of 100 people, out there that have a mortgage, and ask them a simple question: can you borrow the equity from your home? What do you think is going to be the right answer to those 100 people you poll? I'd be willing to bet that the number's above 70 that get the answer to that, incorrect.
Yeah, you can't take the equity out of your home. You can only borrow against it, and that's assuming that you qualify.
Right.
And in qualifying, there's the 5 C's of credit. I just remember it's called the 5 C's. I don't remember them all. I know character, capacity to repay, and you got. The capacity to repay, that means you got to have stable income. And if you don't have stable income to be able to show the bank that you can borrow and repay responsibly, you ain't getting access to it. And, it's funny. We keep seeing the ads. Was it Linktree? No, that's something else. Lending Tree. That was it.
Yeah. David, even if you do qualify, it's not as liquid to get money as you think it is. It's 30, 40 days, how much paperwork we got to fill out to get cash. It's just just a bad plan. It's a bad plan.
Right. And so hopefully clients will get their home equity lines of credit as backup emergency lines before emergencies happen, because that's the best way to do it. Get it before you need it. What's the joke when you want to borrow? The bank wants to sell you an umbrella right until it rains.
Mm-hmm.
Right. I think that's the joke. But I was mentioning a lending tree. They keep saying in their ads, don't borrow from the bank, borrow from yourself or borrow from your home. I'm like, wait a minute. Who am I making the payments to? Really? No. Lending Tree has it completely wrong and misleading. Not intentional. Well, I don't think it's intentional, and it's not criminal. Otherwise, they wouldn't keep doing it. But to be able to borrow against the value of your home and be able to pay it back, you got to pay someone who's going to underwrite the loan and offer you their money backed by your asset of what's available in the value there. But yeah, got to get that in advance before catastrophes happen. I know Mike and I, we were talking about one of his clients. Obviously, we leave names out, but unfortunately, he's hitting a cash flow crunch. And I just wish that he would have gotten a home equity line of credit well in advance. However, keep in mind that in certain places, they have to reevaluate the value of your property, which means it might be reevaluating how much of property tax. Everything has ripple effects. So, but I really wish that despite the ripple effects, people just get the lines of credit in place so that they have it and then be able to have capital when they need it. So this is part of that business planning regarding mortgages, because especially when you're in business, you need as much credit and capital you can get your hands on when needed, and you don't never know when things will happen, and when things happen, you might not be able to get the capital and credit that you need at that time.
Yeah, and it's a story for another day, but it is along the same lines as traditional mortgages. If you're of age and if you qualify, there's a lot of power in the new reverse mortgages and how they're structured and how they're a benefit to we'll say pre-retirees. I think some limits now are like age 55. You can actually have some sort of reverse mortgage, but we have obligations and things that keep us from allowing traditional mortgages to play a vital role in whether it be retirement planning or emergency funds, and that's something good that's come along with the reverse mortgage in the last several years. They're not structured the way they once were. They're a huge benefit now, and I'm an advocate for those that understand it and work with someone who is well qualified in that space, and we obviously have people we endorse for that. So it's also a consideration.
Oh, absolutely. Especially in those retirement years, be able to get your hands on tax exempt capital, because you don't pay, in the vast majority of cases, you don't pay income taxes on loans. I can only think of one exception to that, and it's a very specific type of life insurance loan, but it's usually not the standard. It's usually the exception on that one. So we're looking at the worst case scenario, but let's look at the best case scenario. Everything works out fine, but at the same time, we could have done better with our money. From the same advice from the other guy. Now, we talked about his 12% mutual fund a couple of weeks ago, and we know it's not exactly 12% a year, but it was a good fund.
It was pretty close.
It was pretty close. Not too bad. But we have one of our mentors, because we're on the same financial group, and he has a newsletter. This is out about 18 months ago. And so the rates will be obviously different. It's not the most timely right now. But he says, if you had a 6% mortgage rate, but you have a 12% investment return rate, a $100,000 mortgage at 6% for 30 years, not including taxes and insurance, would have a payment of about $596 monthly. Let's call it $600 a month. Your total payments for 30 years would be $215,000. I'm rounding up a bit. The interest would be about $115,000, or over twice the amount borrowed. But $100,000 invested for the same 30 years at his 12% could be just at $3 million. Now that's a big difference. I mean, we're trying to save interest because we hate interest and we hate debt. I can understand that. But then you're giving up so much other potential by not following his other advice. He's got this silo thinking. He's thinking about one transaction at a time and not coordinating everything together. And if he would coordinate his own advice, he would say, get the 30-year mortgage and put the difference in his 12% fund.
And put the minimum down that you can, and not 20%. Imagine, if the average house cost is $400,000, we'll just use that number, across the United States, and you put 20% down, that's $80,000. If you had that, compounding, in the market at his 12% instead of, a 6%, simple interest mortgage. I mean, the math is outstanding, overwhelmingly terrible. when you look at how much money you're losing by, you know, putting that money down into your mortgage. It's just, the advice doesn't, the math ain't mathin'.
It's not It's not Matt. And I hear your dog in the background who's also agreeing with you, saying this is garbage,
Yeah.
right?
I mean, she's even angry herself.
That's it. But and we think about it, and this is the hard part. Some people think that they're getting a rate of return on the equity in their home, and the fact is, what does the equity actually do? So let's say that we have a I'm going to use a different number, $500,000 home, and for reasons beyond our control, the home appreciates to $1 million. Did your equity grow? No. The fact that what grew was the value of the property. Your equity had nothing to do with that. You know, the additional payments going into paying down the loan against the property, it didn't do anything for that. So
Well,
what is the equity doing? It's doing nothing other than at the time of origination, having a higher down payment should result in a lower ongoing payment. That's the only thing it did. And that's to satisfy the bank requirements.
And here's the other, you know, factor to that is that if your home is appreciating, all of the other homes in your area are appreciating at the same rate. So it's not like you're, you know, going to be able to go out and buy a substantially nicer house in your area because the house appreciated. You can go out and buy the same exact house. So in order for you to actually realize any gains, you have to go out and buy a less expensive house, which is fine. You know, a lot of people in retirement downsize and stuff like that. So there is some truth to that. But those houses also appreciated, you know, theoretically at the same rate too. So you've really not made any money, and you've had the carrying expense all of those years in repairs, taxes, all kinds of other stuff. So this is, you know, again, math ain't mathin'.
It ain't mathin'. And so it was funny. You may not have heard this story. John Savage, who's a legend of the insurance industry many, many years ago, he's talking about when I think they just appraised their home. They kept adding onto their home. And so John Savage was saying, you know, he's got 17 rooms built onto his house. I hope he's exaggerating. I don't know anybody that would allow that in the zone, you know, for residential zoning. He says Holiday Inn might come and buy it, but you never know. He says your home is worth $400,000. He said, write me a check. No, I don't really want that. But his wife would say, hey, we made $50,000. Shows that his wife understood math, but didn't understand. Had little understanding about homes. Because if you sell the house, you got to buy another one.
Right.
Where's that money going to? You just transfer that gain from that house into the next house.
Well,
assuming again similar or higher price.
Well, even if you buy a less expensive house, the less expensive house would have been less expensive in the first place, right? So you didn't really gain anything. You just bought a less expensive house at a higher price in the future.
Well, you know, and it gets into, you know, it also gets into the conversation of, you know, there's nothing wrong with owning your home. I mean, it's not a bad thing. But if you understand how the wealth of things work, you know, I don't know of anyone that really understands how wealth works and how interest works when it's in your favor. Why would you ever really want to own your home? Now, if you have the vacation home on the lake that you pass on to your kids, that's different. But chances are your home's going to be sold when you pass away. Your kids are not going to live in it. You know, they've got their lives and, you know, to live, and they're living somewhere else, you know, in a lot of cases. But if you understand how interest really works and how the wealth of the world works, you really never want to own that property. You know, you want to keep that mortgage.
So let's go a little further on that one, because just imagine being married and going to live in your childhood home. Do you really want to make love to your spouse in that same house? I'm just throwing that out there. Okay. Now, unless you got a really nice, and I'm talking about estate style mansion kind of a thing, unless it's a really good lifestyle upgrade there, I don't think I want to do that. I'm just throwing that out there. Your adult kids do not want to be trying to build a new family in the same household that they grew up in.
Hey, they want to sell that house and they're going to move to Cabo. You know, they're or wherever. You know, I mean, really, we meet with enough people to see kind of how that works. You know, most people don't. You know, they don't inherit the family, you know, property and keep it. They wind up selling it.
Well, you watch these shows on TV, you know, and all of these parents that leave all this stuff for their kids in the house. You see them come with dumpsters to pick all this stuff up. Not these, you know, kids don't necessarily want all this stuff. There might be some valuable things and things like that in there, but generally speaking, the kids sell the house and get rid of all the stuff. There's not necessarily anything that, you know, kids want to necessarily move back into their parents' house. I mean, now that you brought it up, Kinder, that is kind of an awkward thought of being in that same bedroom. So
He's in California though. Things are different in California.
well, you know, fair enough.
Sorry, it's what came to mind. I'm just like, you don't want that house. Oh God. Okay. Now let's talk about that down payment though, because one of the reasons that we go with that 20% down payment is what they're told. We want to make sure, obviously, you want an affordable payment. That's important. But the other part is that PMI, private mortgage insurance. And there's some misconceptions a little bit about that, strangely enough, even among financial professionals. So the PMI, who is it for? It protects the lender. So in case something happens, you can't make payments on it. It's additional insurance for the lender. It helps them recoup their costs and mitigate their risk. It's not about your family. And so we were doing some math on that. How much is PMI? We determined that the average is between like about 0.5 to 1.5% a year. And that's based on when you're borrowing more than, and I'm rounding up, 80% of loans to value. So if you have a $500,000 home and you're borrowing more than $400,000 on a first mortgage, then you're going to need to pay PMI on those payments. And that 1% is what, $5,000 a year? So $5,000 a year, divide that up, you know, and it's paid out monthly. And yet, all because we're trying, you couldn't get the mortgage structure. Now, some lenders what they'll do is they'll actually do an 80% first mortgage and then the remaining difference as a second mortgage. And that can help you save for PMI. But PMI shouldn't be the biggest issue. Mike, we were doing some math on that. Do you have that there available? Can we expound on that?
I don't have it in front of me. I can get it pulled up again, though, if you want to keep going on with something else.
Well, yeah, so the PMI costs, I mean, if that's the biggest issue towards buying, now keep in mind, and this, I wasn't planning on talking about this, but a home is not an asset in terms of the way we want to define an asset. A home is a liability. An asset, as the way we would define it, is something that brings cash flow into your pocket. Now, the home can be a capital appreciating asset, but unless it's paying you, it's still not an asset. It could be an appreciating liability. That's an interesting connotation of terms, right? So it can appreciate in value, but if you don't maintain it and if you don't make your property tax payments, and you don't pay the payments on the mortgage, don't keep the homeowner's insurance, the home could be taken from you. So it's not completely yours unless you're making the payments. And it's not an asset until it starts paying you, which at another time we'll talk about reverse mortgage. That's another episode altogether. But in order to get it, yeah.
No, I think we figured that the cost per 100,000, if that's what you're looking for PMI, was around $40 a month.
Yeah, per 100,000. So depending on which part of the country you're in, if you're again, depending on how much is above 80% of loans to value, that's how much you're going to pay. Now, California, if you're borrowing $1 million and the whole thing is over 80% of loans to value, yeah, you're going to be paying quite a bit more. But we figured that out to be basically $1,000 a month, 800, whatever that math turns out to be. But if you're borrowing $1 million, you should be able to cover an extra 800. I wouldn't let that be a limiting factor to prevent you from getting the home. And yet some people think that, well, if I don't have enough down payment, I've got to pay that PMI. Whatever that math turns out to be, figure it out. But as soon as, this is what we looked up, as soon as the first mortgage position is at 78% or lower of loans to value, so your principal amount on that first mortgage, once it hits 78% and lower, the PMI disappears.
Mm-hmm.
So why wait if you can still afford everything being equal? No reason to really wait on that. That was our conclusion, right? That's what we figured out.
Yes.
Gotta remember that. Yeah, that's what we figured out. Okay, so now here's the other fun part, which is the tax benefits of owning a home. And the main thing that we like is that the interest component of your mortgage payment is deductible, and that's a true deduction. It's a straight deduction off of your taxes. Now, thanks to the Trump, you think Trump liked real estate, but thanks to the Tax Cuts and Jobs Act that was passed at the end of 2017, enacted for the next year, 2018, the amount of homeowners interest, the home mortgage interest deduction was limited to $750,000 of home acquisition cost. Everything above that is no longer deductible, but it's still $750,000. Not too bad. Used to be $1 million, so they lowered that. But at least that was a true deduction on whatever interest was being paid. Now, I'm going to assume that most people don't know how mortgages are amortized, and that's kind of a technical term. Amortization basically is the process for lenders to front load all of their interest as much as possible up front. And this is why when we read about mortgages, the first usually 7, 8, 10 years of those payments are largely interest payments. So almost all of that is deductible. Then it starts blending in so that you're paying more in principal than interest. And then towards the latter few years, you're not paying any interest, you're paying far more principal in pay down. And this is the way banks make their money. And so we have to remember, it's not the payment that's deductible, it's just the interest part. But are we being smart with how we're coordinating those decisions with everything else that we're doing? So I want to share a quick video. I think it's about 2 minutes. Tom Love talks about the difference between postponing a tax and having a true tax deduction. And especially he's talking about for a 15-year mortgage. Let me share that real quick.
My name is Tom Love, and I'm the founder of the Breakaway League. I'm going to talk to you here in a couple seconds about the difference between understanding deductibility and understanding postponing our income tax bill. I'll ask a prospect or a client, if you had to write a $10,000 check today, you were mandated, you had to write a $10,000 check today, would you rather that $10,000 go to some place that will postpone your income tax liability? Or would you rather write that check for $10,000 and deduct that $10,000? Now, when asked in that manner, most people will say, I want to make the contribution to a deduction. And they think I'm asking the question because contributing to a qualified retirement plan is a deduction. It's just the opposite. Those same people are the ones that are being told through social media and through banking advertisements, you need the 15-year mortgage instead of the 30-year mortgage because you want to own your home. Well, here's the difference when I was asking postpone with a $10,000 check your tax bill or get a $10,000 tax deduction. Interest on a home is deductible up to $1 million. Now, those rules may change over time, but home ownership interest is still a deduction. That will reduce your tax bill immediately and for life. You don't owe any of that back. If I make a contribution to a qualified retirement plan, I'm postponing the tax to some point in the future that I have no idea what that bracket will be. So when I ask, would you rather go to something that will reduce or to postpone your tax? Most people understand I want to reduce it. Yet they're the same ones that are paying their houses off early and they're contributing maximum amounts to their government-sponsored retirement plan. And as a result, they're doing the exact opposite of what they are asked. Very simply, do you want a deduction or do you want to postpone the tax?
Wow.
So again, I keep talking about that silo thinking versus coordinated financial decisions thinking. So he's talking about the fact that most people want to put their money, the maximum, like in Roy's story, he put the maximum amount in his 401k plan, can't get at it, and at the same time, paying off the home really quick so that you have your lifetime deduction is great, but then you set yourself up to be paying the highest amount of taxes you possibly could because you put all that into an account that we can't even calculate how much tax we owe.
Well, it's just that's a great clip. I mean, that's a great couple of minutes right there. From Tom, who obviously we just enjoy everything that he's taught and teaches all of us that will listen to whether it be his podcast or a YouTube clip or whatever. But that's all factual, good information right there that goes back to if everything you thought to be true turned out not to be true. When would you want to know? I mean, really, because there's so much that's not true about how money works. And we've all been taught whether it be from the financial institution that you're affiliated with to your local bank that just doesn't understand what's in your best interest. And that's, that gets back to it being on the client's shoulders, and hopefully that they run across someone that they can work with that has done their due diligence, done their work, and, is an advocate for their client, not for the institution they represent. And it's just, everyone should go back and listen to that clip multiple times. There's a wealth of good information in that couple of minutes there.
Yeah, absolutely. And keep my, I've got those letters after my name: RFC, CHFC, CLU. And a lot of that is also silo thinking. And it takes a while before you finally coordinate it all together and figure out how can we make sure we're really advocating for the client, not just explaining what the institutions want us to explain. And that's a lot of what a lot of financial education is all about, making sure that you're compliant, you're not misrepresenting anything, but are you really advocating for the client? Hence why we call it the Financial Advocacy Podcast. We want to help our clients and help the public think a little bit differently. Let's challenge that conventional wisdom, help people to see the consequences of the decisions they've already made and what's available to them to make better decisions going forward, and let them decide what's best for them, which is so important. What we all believe in doing for our clients. So, but one of the things, and we touched on this a little bit, because PMI, private mortgage insurance, protects the lender. But there are various kinds of life insurance that will help pay off the mortgage for a family if something were to happen. And I love the fact that that message is getting out. And here's what I want homeowners to think right now. So I want you to think, do you have a mortgage on your home? Usually the answer is yes. And if the answer is no, you probably are renting. And if you're renting, do you have a fund that will help keep the rent paid for your family if something were to happen to you? And usually the answer at that point is, I probably don't. You probably have some savings. How do you feel about that? And same thing for a mortgage. If do you have insurance to help pay off the mortgage, or at least make the payments for a considerable period of time if something were to happen to you? And they usually don't, or they have something through work, right? And there's the group coverage, and you should maximize that group coverage wherever you can. Group coverage is only as good for as long as you're working there. Because once you leave, or they let you go, layoffs or whatever, that group coverage is gone in almost all cases. So how do you feel about that? What would happen if nothing changes? What would happen for your spouse? Would they have to sell and move? Would they have to get a job? And I'm going to put out my own judgment here. Some really inconsiderate husbands would probably say, well, she could get remarried and she could go get a job. Well, why isn't she working now? Is there a particular reason why she's not working now? And if she could get a job, could she earn as well as you do now? And I'm saying she, naturally, because that, I'm speaking from first person here. And usually the answer is no. So, well, what would you like to see happen? Would having insurance be important to you to help make sure that your family's protected? And usually the answer would come up to say, yeah, it's important, but I just can't afford it. Well, if we could take a look, and if I could sit down with you and share with you some ideas that you can protect your family, get the insurance you need to protect your family, and do so without taking any additional money out of your pocket, would that be a worthwhile conversation to have? And to me, that's a no-brainer, unless I really don't like you. That would be the only reason, So, yeah, that would make sense. Great. When can we get together the next couple of weeks? And we could just start, we can have a conversation and see what we can do to help protect your home for your family, just in case the worst happens. It's that kind of thinking. Now, unless the guy's a true jerk, part of me would say, and I got this from someone else, you should mail them a letter and mail them an envelope, make it empty, but put your name in the return envelope, in the return corner. And, and they'll call you and they'll say, well, what's this about? I said, well, I just want to let you know your husband doesn't have any life insurance. And when he passes, I want to make sure you got used to the fact you're not going to get anything. And they're going to hate you and they're going to buy insurance. They're just not going to buy it from you. And that's okay. It's a terrible thing, but it'll get their attention, right?
I would think so.
You would hope, right? I mean,
I would hope that we can at least get their attention. They might think of you as a jackass, but that's okay. We're advocating for them to make a good decision. They're just not going to buy it from me, and I'm okay with that. Now, there are programs out there, and especially new homeowners, they're going to get inundated with a ton of mail and everything. And Mike, this is your moment here because you've got such strong opinions, and I want you. You ready to share your screen? I want to make sure that you go off on this thing because for healthier people, they can really be taken advantage of and not really know it. So,
right. Well, before I do that, I want to preface this with any life insurance, I'm always going to say is better than no life insurance. So I want to start with that. And before you make any decisions and go try to replace any policies, don't cancel any insurance that you currently have in force, just in case something happened and now you're uninsurable. So always make sure, if you're going to change policies or get something else, make sure that you don't cancel anything before you have something else in place, because then you could be without insurance altogether, and that's an even worse situation. So, even though they may not be the best programs, at least having some life insurance is better than having no life insurance. So I want to preface it with that, and I also want to say that you can. I don't know how to say this without going off on people. If you've ever gotten one of those letters in the mail that looks like it's from your lender talking about buying a program to pay off your mortgage in case of accident, sickness, death, things like that. That's kind of what we're talking about with these simplified issue mortgage protection type life insurance policies. Now, again, something's better than nothing, but I'm going to share my screen and let's take a look at what the cost comparison is between getting a simplified issue mortgage protection and then, using accelerated underwriting or fully underwritten. The difference here is that accelerated underwriting, they're not necessarily going to require labs and blood pressure and a paramed visit and all that stuff. Whereas fully underwritten, they're going to have the paramed come to the house. You're going to have your blood drawn, pee in a cup, all that stuff. So there are different degrees of this. The one nice thing about accelerated underwriting is that most insurance companies will issue up to $1 million or $2 million without any blood work. Some are higher, some are lower, but you don't have to do the blood work and the pee in the cup. If you want to get more on that, generally speaking, you're going to have to do a fully underwritten policy anyway. But you can get basically the same pricing with accelerated underwriting as you can with fully underwritten policies, and they do have some limits on how much you can get in age limits and stuff like that. But generally speaking, for the audience that we're targeting, their 30s, 40s, 50s, those limits are pretty high. And if you're at all reasonably healthy, that's going to be much better for you. If you've got some health issues and you're really concerned if you can make it through underwriting, then maybe one of these other type of simplified issue policies could be for you. But generally speaking, if you're healthy overall, I hate to call it this, but it's basically a scam. You're paying probably almost twice the cost of what you should be. So I'm going to use Mutual of Omaha in this example. I just happen to have their page up. I love Mutual of Omaha. They're one of my favorite companies. They've been around for a long time. There's nothing wrong with them. It's just that they're easy to do a comparison with, and they happen to offer both of these policies. So let me share my screen here. And let's take a look here at our Mutual of Omaha quotes. Give me one sec. All right.
there you are. You're sharing your screen.
All right. You guys can see that, right?
Yep, we got you.
All right. So we got all of our products here, but we're going to go down to these two, Term Life Answers and Term Life Express. So Term Life Express is their simplified issue product. And I'm in Illinois, so we'll just use Illinois. And we'll leave their default here. We're going to look at a 40-year-old male, non-tobacco. We'll use our 30-year non-return of premium. And the average, cost of a home is $400,000 across, the country. With their simplified issue product, the most you can get is $300,000. So we'll use that. and we'll put that in. And this is a payment mode of monthly. And let's just hit calculate. So this premium is $137.77 a month for only $300,000 of coverage on a 40-year-old male non-tobacco. So obviously tobacco rates are going to be typically much higher. So there's not necessarily a reason to quote those. But let's go back and let's look at term life answers. Now this is their Mutual of Omaha doesn't offer an accelerated underwriting product that I'm aware of. So this is fully underwritten, so this would require the paramed exam, but we'll use this anyway. And this is our standard non-tobacco rate. So how life insurance rates work is you get standard is standard. That's what most people should assume they're going to get. It's standard for a reason. Your typical 40-year-old male should assume that they're going to get this rate if they're in standard health. If you're preferred plus or preferred non-tobacco, that just means that you're going to be healthier than the typical 40-year-old male is. And so the life insurance company is basically giving you a discount and they're going to give you a better rate. So we're going to run this standard non-tobacco. And unlike all your online quotes that you see online where they give you the super preferred Superman, best class you can get on an 18-year-old female, on a 10-year term, this is going to be a real quote, not some made up nonsense. So, and we're also going to go for our 30-year. And we're going to do the same 300,000. All right. And we dropped ourselves all the way down to 77.10. So almost, 50% less cost just by not purchasing a simplified issue mortgage protection policy. That to me is borderline criminal. Now, if we actually get a preferred plus rate, God forbid that somebody is in perfect health that buys one of these things, we're all the way down to $40 a month. So, if you ever get one of those things in the mail, one of those flyers that talk about mortgage protection insurance, again, having some life insurance is better than having none. But this is the kind of stuff that they're trying to sell you, these simplified issue mortgage protection policies. And I don't see the benefit of it. Again, at least you have some life insurance instead of none. But in all honesty, it's a borderline scam, especially if you're a reasonably healthy person. There's no reason that you should be purchasing something like this. If you are worried about your health or you have a couple, things going on, maybe it makes sense to do a simplified issue product and try to squeeze through underwriting. But the problem with that is that if you are unhealthy and you don't disclose everything to the insurance company and you die within the first 2 years, with any life insurance policy, there's a 2-year contestability period. So if they found out that you had something in that first and you pass away in the first 2 years, you won't get the death benefit. You will get your premiums back, any premiums that you paid into the policy. But the insurance company will not pay the death benefit out. They will just simply refund your premiums and walk away. So it does not, I don't see any world, and this is a pet peeve of mine, where purchasing a simplified issue mortgage protection policy makes any sense. These policies are basically priced at a table D, which is, 100% of the standard premium. So it is almost twice the cost of the standard premium. These policies are rated at a table D. You are actually table rated when you're buying these products. And if you're in any kind of decent health, I'm sorry, but you have been scammed. And, if this is something that you want to fix or look at, feel free to reach out to any of us. We can put our info out there for you guys. We're more than happy to take a look at it, see if there's something we can do to help you. But whatever you do, you may be a little bit upset right now for purchasing one of these things, but understandably so. But like I said, don't cancel it until you get something else in place, because at least you have something. And if you do pass away, even during the time that you're going through an underwriting process, your family will still have that death benefit there. So if you have it, keep it for now until you find something else that's better for you. Don't run out and cancel your insurance just because it's overpriced, because you never know. Maybe you won't get through underwriting. Maybe your health has changed. Maybe other things. Maybe you are rated higher than a table C or D now because of a health class. Something happened with your health. So don't whatever you do, don't cancel the policy just immediately, but feel free to reach out to somebody like myself or Kurt or David or another local agent that knows what they're doing and that doesn't just push, simplified issue mortgage protection life insurance, and get a real quote. And I gotta say this: stay away from the online garbage too, where they tell you that you're gonna get, $1 million 30-year term for $25 a month. That's a scam too. You're gonna fill the form out, and it's going to come back at, whatever it is, $250 a month. And you're going to be like, well, what happened? I mean, this stuff doesn't exist. These are all clickbait things. Like it's all just there to make you click on it and buy it. And mortgage protection is just a form you fill out in the mail. They even make it look like it's from your lender to make it even worse. So stay away from this stuff. I would talk to a local agent of somebody you trust if you really want, a life insurance policy to cover your mortgage in case you pass away, or reach out to one of us. We're licensed all over the country. If I'm not licensed in your state, I'll gladly, become licensed in your state to help you out. But anyway, that's my little rant on mortgage protection, simplified issue life insurance.
Good rant there, Mike.
Excellent.
That was good. But yeah, it literally, it's a bait and switch tactic because they're going to tease you with these low rates that are not necessarily based in reality. And then they have to come back and say, oh, I'm so sorry. We really tried with the underwriter, but the best we can do for you is standard. And then it ends up being whatever it is. All we have to do is set better expectations.
Right. Well, and that's the thing. Whenever I run quotes for people, I quote everything at standard. I don't care what health you're in. I quote everything at standard. And if the insurance and if they want to see the preferred or the preferred plus or the Superman or the whatever rate, I'll show it to them and I'll say, look, this is the rate that you should expect to get. Standard is standard for a reason. Okay. Most people get standard. If you get anything better than standard, that just means you're in better shape than the average person of your age. So just keep that in mind, that I can show you whatever rate you want. I can put the Superman rate on the app, no problem. I can show you any price that I want. That does not matter. The only thing that matters is what the insurance company says your rate is for the policy. So I could put that the premium's going to be $1,000 a month on the app, but if it comes back and you're only going to have to pay $100 a month, that's all you're going to pay, and vice versa. It literally does not matter what the insurance agent puts on the app for the premium. All that matters is what the insurance company says that your premium is going to be based on your health.
Boom. That's it right there. So yeah, it's all about what the actual offer is, because you will get it. So if we submit it at standard, and if you are eligible for a better rating, you'll get it. So,
in fact, I just had that happen to a client the other day. She is in her 70s, and I submitted it at standard, and she came back at preferred.
Yep.
So, I mean, they go ahead.
Well, it's interesting, and I'm thinking about a case that I think this might have been Kurt's case about a year ago or so. Someone was so hung up on getting the proper rating that they dismissed the entire case completely because they were so hooked on saying, I deserve a premium elite preferred plus whatever Superman preferred thing it was, and he didn't get it. He got standard. And he said, no, I deserve that. It's kind of like, if I say this, it'll be sexist. But it's like a woman saying, I don't want that dress because it doesn't come in a size 6 and I'm a size 8. Now, again, I said that as sexist, but let's think about that. I mean, if the dress fits, no man is going to ask you what the number is on the tag. I'm just throwing that out there. No one else cares. Is it going to do what you want it to do? It should be fine. But I know, and I probably just made the biggest cardinal sin of applying male logic to a female thing. But I'm just saying, I'm sure going to get some hate mail for that. But that's okay. That might drive traffic. It's terrible. But, but still, if it does the job, it doesn't matter what it's called or what the rating is, as long as everything else fits. So that's the point I'm trying to get, is to look at the bigger picture, not just the underwriting class that the insurance company said you get. Okay, that was my little rant on that.
Well, you're back to your point, Mike, about what's going on, on the social media waves with this. It's out of control. I mean, it is really out of control at what agents, I'm going to pick on the agents that are doing it wrong, but it's a fact. There's so much on social media with every avenue that you go down, pitching this mortgage protection garbage, and these inflated numbers that they're putting people in products that for X amount of dollars that they could get some done properly and structured properly for 100 times that in coverage and half the premium. It's just it's unfortunate, but it's the way of the world now. Everything initially is a scam, and you gotta sift through the ashes to find the good stuff. So
well, the other thing too, and I don't necessarily think that, I would hope that agents are doing this intentionally, is that with these simplified issue policies, the agent gets paid almost immediately because there's no underwriting basically. And I have seen some IMOs structure compensation for simplified issue products to pay more commissions to the agent than fully underwritten ones do. So there is a huge incentive for the agent to sell a simplified issue policy, because not only do you get paid immediately on a higher premium, you get a higher commission level on it too. That they inflate the commission a lot of times. If you look at if you're with one of these 3-letter IMOs, go look in your back office and see what the simplified issue policy pays on a commission rate versus what the fully underwritten policy pays, and you'll start to understand a couple things of what's going on here and why they all push this. And even the agents love it too. So there is a huge incentive for the agent to sell it as well, because not only do you get paid immediately, but you get paid a higher commission and a higher commission rate on it.
Yeah, makes a lot of sense. And of course, the sales pitch is, we could get you covered without you having to pee in a cup and having your blood drawn. And I understand that there's some people that really have a fear of needles. I'm sorry. Well, I'm not going to coddle you. I'm going to say, get over it. Blood work is a fact of life. The older you get, you should be getting your blood drawn probably once a year anyway. Just by if you're seeing your doctor trying to take care of things. So I'm like, you know what, you got to do it. And at that point, I'll be like, maybe I shouldn't be working with you. I need someone who's willing to do what's good for them. But as you said earlier, there's also the accelerated underwriting programs where it's not even necessary. So it all depends. But yeah, we really got to look out for what's best for the client. I do like convenience, but at the same time, let's all be adults. You need to go get your blood drawn and everything anyway. And by the way, if we don't do full underwriting, let's go back to about 20, 30 years ago. How did Magic Johnson find out he had HIV? He applied for a Mass Mutual life insurance policy. They drew his blood. They found the factors in his blood, and that's how he found out. So sometimes we might not even make the sale. You might get declined, but darn it, you might find out you've got cancer and that you can address it now. And so sometimes these things are life-saving news. You don't like it, but you can start doing something about it.
It's funny you mentioned that, because a few years back, I don't know, I think it's somewhere 4 or 5 years ago, I had the exact same thing happen with a female client, that had really neglected her own health to a degree and not engaged in an annual physical and annual exam. And we had parameds ordered, fully underwritten, come back, diagnosis wasn't good. And she wound up being, uninsurable, but she also found out that, she had a health issue that she needed to get addressed. So just another reason to avoid simplified issue when you can. And like you say, David, put your big pants on and get your blood drawn.
And on that note, I think we're good. There we go. My friend Alonzo Hall, salute to you. Glad that you're on paying attention. Appreciate you, brother. He's my brother from another mother. So anyway, with that in mind, thank you all so much for being on. Hey, we did it pretty good, just an hour. I was expecting it to be longer than that. But we'll catch you all next week. I don't know what we're going to talk about next week, but obviously we're going to keep going on some of these fundamental topics. And then eventually, again, we'll probably have some guests coming on. Brian he says he has 1 point to make. Uh-oh. Almost afraid to know what that is. I don't know. Is he going to type fast enough for us, or are we going to just cut him off?
Go
All right,
quickly.
see you,
Who's paying
Brian.
attention to us? Standard tax deductions are getting so high. Yeah, that's true. So compared to what's deductible for homeowner interest and such. And he's saying that most will not be getting Schedule A deductions. This is the accountant talking, that, ladies and gentlemen. So yeah, it's important to coordinate that. So we didn't even coordinate much of that with the tax code itself, other than you can deduct, not necessarily will it be an effective deduction. So
Good
whole other
points.
thing.
Yeah, good point.
So mortgage interest will not factor into that part of the calculation. So there he is. Okay, wow. Well, we had to bring out the extra bad news right here at the end. All right, ladies and gentlemen, we'll catch you all next week. Thanks for chiming in. See you then.
We'll have Brian on here at one point. We'll get him involved as an accountant and have him play with some
Absolutely.
numbers and show us some stuff, because he's
one last thing. Everyone to have a safe and happy holiday weekend. We got a long weekend here, Memorial Day weekend coming up. So remember the reason, and while we're all citizens of the U.S. and able to have the freedoms and liberties we have,
Amen.
part of that is for Monday. So see someone.
Absolutely. It's always in honor of Memorial Day. I always get kind of confused. Why does somebody say Happy Memorial Day? Like, really? Have you not analyzed that statement? Happy Memorial Day. Really? No, it's in honor of Memorial Day. And yes, and this is about those that have fallen, not the veterans, not those that are currently serving. It's about those who have fallen. Somehow we get it all mixed up. But
Yeah.
Great point, Kurt. Thank you so much for bringing that up. We will catch you all next week. See you then. Thanks for tuning in.
Bye.